One of the key factors that is causing problems with data management is legacy systems being built on very old technology, and it makes it really hard to integrate with more modern and downstream processes. Another issue, especially around sort of actuarial back office, is the lack of a centralized data management system, which make the transparency and the lineage of data really hard, and that cause processes to be very heavy on controls, which most often is then done manually. I think it's time for the insurance industry to get in line with the 21st centuries and modernise their systems, and also to go and learn from other industries. The whole problem about data management is not unique to the life insurance industry. There's a lot of other industries out there that had this problem for years and have already solved it, and I think there's real benefit for insurance firms to go and learn from what that companies have done. When do so, make sure you take an holistic view in implementing the new systems, because at the end of the day, silo thinking create problems where holistic views solve those problems. Most insurance companies do hold margins in their solvency ratios. More concise and accurate and even more sort of timely data will enable companies to have more confidence in their capital numbers. It will also give them the ability, especially sort of more efficient processes, to be more reactive on any threats that may be on the horizon. And I think all of this will give them sort of comfort that senior managers will get in the ability to be more reactive, will enable them to reduce the margins that they hold on their solvency ratio, and that will give them the ability to take advantage or take more risk onto their balance sheets. And I think that way they can create a lot of value for their shareholders, but still protect the policyholders as required by regulators. The key challenges is for insurance companies to get to grips with balance sheets that's much more volatile compared to the previous regulatory regime, and we've already seen some evidence of that when interest rates dropped in the first quarter of this year. There was a lot of our clients who really had to work hard in order to keep them solvent. And to some extent, you may think that the ICA, which is a previous regulatory regime, was market consistent as well. But I think the key difference here is that Solvency II is a public disclosure on a quarterly basis, and therefore insurance firms just have to be more reactive in their risk management compared to previous regulations.